Investors are piling into gold because they know what's coming next, and they know that inflation is not under wraps. We just saw the PCE numbers come out here not too long ago, and they met expectations, but they still are floating around that 3% rate, and it doesn't seem like it's going around. Inflation is sticky. It's not transitory. Yeah, you guys all forgot that they were using that word at one point in time where saying, hey, inflation is going to be transitory. We're going to see it pass through and everything's going to be fine. No, 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 not so fast. We're seeing inflation stick around and stick around for good. And now gold is sending a major warning to the market. And we're seeing all of these investors dump into gold. I mean, GLD has pulled in more than $2 billion worth in September, and they did the same in July as well. It's the largest ETF, and those 2.3 billion in net inflows, well, it marks the 7th monthly net inflow over the last 8 months, and the year-to-date data has pulled in 13.4 billion, the most since the 2020 pandemic. Meanwhile, gold held by bullion-backed ETF reached its highest level since mid-22. As a result, gold is on track for its 7th quarterly gain in the last 8 quarters. Now, the gold reserves in the U.S. are also skyrocketing in flight, as we haven't had them necessarily revalued yet. But if you look at the amount of gold that the United States allegedly has, well, it's past that $1 trillion. So it now holds 2.4 times more gold than Germany, the second largest holder in the world. And it's telling us a big sign here. Gold is up 44% year to date. Gold is now 3.5 times more than the S&P 500. And that's with the strongest 5-month bull run that the S&P 500 has ever seen in history. So historically, these two are not correlated. Usually, gold rises when stocks fall and not vice versa. But we're seeing both of them really start to take off right now. So gold and the S&P 500 are racing through, and we're seeing gold now on track to post its best year since 1979. And that's when the U.S. recorded inflation was 11%. Now, we aren't there to those crazy numbers just yet. We're going to get into the inflation numbers here in a minute. But seeing these same numbers and in the conversation of being, hey, this is when inflation was 11%, gold investors were doing this. This is a very similar time. That should raise your eyebrows a little bit here, folks. That should definitely raise your eyebrows. So not even the 2020 financial pandemic and the 2008 financial crisis or the 2000 dot-com bubble did we see gold post a 40% annual return gain. Those are all these crazy bubbles. And now this move puts U.S. gold holdings at $1.1 trillion. Now, taking it a step further, here's the world's largest gold holders. Of course, we got the USA coming in hot at number 1 with Germany number 2. And gold owns 8.1 tons of gold, or US owns, excuse me. That's 2 times more. And all the central banks have been stocking up on gold. Now, I think that this China number is more than they're going to be letting off, if I'm being completely honest with you, because China has been stacking gold for a while. And, we never really can really trust the reporting out of China here lately. But we are seeing a lot of governments and central banks start to pile into gold. And these central banks continue to buy a ton of gold every single quarter. They've bought 166.5 tons of gold in Q2, 41% above the average quarterly purchase from 2010 to 2021. So why are they doing all this? Because everybody is losing faith in the dollar, and we're also seeing a ton of rate cuts. In fact, we're seeing 168 rate cuts so far in the past 12 months, and it's the 3rd highest reading of this century. The other 2 times that we saw this were in October of 2009, where obviously we had the great financial crisis, and then 2020 when we had the world shut down. So the previous cycle was 196, but it's not because inflation is down. The Fed is interesting too with all of this because everybody's saying, oh, gold is screaming a warning. Something is deeply wrong in the US financial system. The metal has been grinding higher day after day, torching every other asset class with stocks stumbling, everything. Look, I mean, this right here, come on. But either way, we're seeing gold really just take off. It keeps powering new records, even topping a 45-year inflation adjusted high. A 1-month chart tells more of the story. I mean, look at this. Gold is just absolutely crushing everything. And so the Fed has explicitly stated that the rate cuts have only resumed due to a weakening labor market. But like I said, we had Fed cutting rates with 2.9% core PCE would be the first time that this is happening in 30 years. And like I said, it wasn't like this was out of the question. No, no, no. This 2.9% was expected. And so all of this that we're seeing is something that, hey, it's par for the course. We're expecting to see inflation data this high. We're expecting to see, gold really do well. But the unique thing with all of this is you guys should be hitting that subscribe button. That's the unique thing. But beside that, is that we are looking at the potential of the Fed cutting interest rates with such high inflation. I mean, the personal consumption expenditures showed inflation in August at 2.9 on an annual basis, rising 0.2% month over month. Both were within estimates, but spending and income numbers were slightly higher than expected. And that's what we're trying to see here. Right? This continuing to go up. That's spending and all of these things, income, hopefully. But as CPI continues to rise up, 72% of CPI components are now farther ahead, are now bigger than that 2% target. I mean, like I said, if you guys have been following the channel, I've been following this closely, which is showing that inflation is not going away. So by comparison, when the Fed last was cutting rates before, obviously, the COVID, pandemic, 57% was during the 2018-19 period. And the Fed was cutting interest rates then. I don't know if you guys remember that. Everybody always remembers the massive amounts of cutting and raising and all of these things. But what we're seeing now is, well, it's very top heavy market. And the dollar, the Dixie, its purchasing power is having its worst year since 1973. And we actually got the Dixie nearly at 98 today. But year to date, I mean, staying down. It's not going anywhere. It's down nearly 10% year to date. So, I mean, the Dixie just sticking around here, which means inflation's high, which means what everybody's seeing is, a really poor valuation here. And then we're seeing, weaker dollars, which means gold and Bitcoin have seen historic gains as a result, because these are what people think of as inflation hedge. And then on top of it, we have the United States government essentially coming at the Fed, yelling at them, basically saying, hey, you guys need to cut interest rates and you need to cut them now. Do it quickly. Right? So is the Fed going to actually cut interest rates? I don't necessarily think so, or I don't necessarily think that they should, excuse me. I mean, I do think that they are going to cut interest rates. I mean, if you look at it, right, here in 29 days, basically 30 days, and just about a month, we have an 89.3% chance that the Fed cuts interest rates just 25 basis points. And now, for those of you guys who remember and have been following with me, I've been following this for a while. And when they first cut interest rates, it wasn't like, oh, they're only going to cut interest rates, 25 basis points, or they might not cut at all. it was, okay, how much are they going to cut? 25 or 50 basis points. Now it seems like the closer we get to this day and the farther along we get with the Fed discussing all of these things left and right, well, it seems like there's more of a possibility that the Fed is not going to cut interest rates. And if they don't cut interest rates, I think that's when you see things starting to get catastrophic. I recorded a video yesterday where, essentially we're saying how big of a bubble that we're in because AI and the overall United States equities, everybody is just essentially piling into, equities right now. It's the biggest distribution of household wealth in equities in a single asset class that we've ever had when it's specifically just equities. Usually it's the housing market. And this is what caused the 2008 crisis is when, households had majority of their wealth in housing and then housing crashed. Well, now we have a similar kind of layout right now in equities. And so equities are more liquid, they're more volatile, and they move a lot faster than the housing market. So this could end up leading to, potentially a very cruel winter, to say the very least. But, on paper, equities have been crushing it. I mean, hitting all-time highs left and right and continuing to rise up. But the one kicker with all of this is if the Fed, like I said, decides to not cut interest rates, the equities have priced in 3 rate cuts by the end of the year. Now, if the Fed decides, all right, we're only going to do 2, we're going to skip this next meeting, that's when we're going to get into some hairy territory. We've got a lot of potential issues here, but the problem is the market's always forward looking and trying to predict to the Fed what they're going to do. And the Fed has been very unpredictable here lately. So I'm going to keep diving into the battle here, but make sure you guys are hitting that like and subscribe button for me and joining my man's McLovin. And we got Foster in the chat. What's going on, fellas? But the Treasury Secretary says that the Fed rate cut is needed for the economy as worries continue about tariffs. And that's a crazy thing is that they're always blaming these tariffs or tariffs this, tariffs that. This is what it needs, to loosen things up, right? But on paper, like it said, the Treasury counselor warns that high interest rates could be a headwind if the Fed does not act because it's restricting economic activities. The interest rates cannot be a headwind for growth at where they're at. The 3% plus growth rate is great right now, but we're not going to be able to sustain that. And, we've been detailing a lot on this channel how housing has been affected. Well, to be honest, I don't think that housing and mortgage rates, we're going to see a big dramatic change because like I said, this essentially is priced in. So, if you look at the mortgage rates right now, they've been falling since July. Even though we've only had one interest rate cut, it's all like, all right, we see that this is coming. So there's been this pullback. And mortgage rates didn't keep falling last year, even as the Feds maintain its 2 or more times. But I mean, I think at this point, we're going to start to see however many we're going to start to see more rate cuts come in. And if they do, we won't get to see the layover effect in mortgage rates just yet. We'll see that coming. I guess my prediction is like early next year. That's when I think we'll see rate cuts really, or mortgage rates really start to come down. And that's when things will start to get pretty interesting here. So you got to keep a close eye on what we got going on. But these mortgage rates falling, well, the 30-year mortgage at 6.35, I mean, that's still extremely high compared to what a lot of people have their mortgages at right now. I mean, if you look at it just granularly, right? If you have a 3% mortgage, which I believe 40% of all mortgages have 3% or 4% or lower right now. So you have a low mortgage rate and housing hasn't really gone up. So why would you sell your house to go to maybe a little bit better of one, but even at the same price, you're going to be paying more in interest. So unless you have a lot of, equity in that house and you want to just dump it all back into another house, you're going to be running into some issues. So I'm going to be detailing it all here on this channel. Make sure you guys are smoking that like and hitting that subscribe button for me, telling a friend to tell a friend, and I'll catch you guys all at the next one.